operating budgets calculations in terms of production, material, labor, overheads, and then we will make financial budget, that is cash collection and disbursement. If you combine them, it will become a cash budget and perform a financial statements. So I start with the sale forecast. This is the first thing in a budgeting process. So once we start the budget, we start with the income. So sale predictions are very, very important. And if you are good in prediction of sales, means that your overall budgeting will be very, very good. So what I assume is that in exams, sales budget need to be given because we cannot do a forecast in the school in the exam. So the first thing that we have is the sale forecast. So how we do forecasting is depend on different methodologies, math, and assumptions. So, for example, start by looking back at historical trends. So, sometimes you see what is the past trend, and based on you predict. For example, if there is a kid who failed every time or having very low marks since grade 1 to grade 9, so you can easily predict that if everything remains same, the kid is going to be in a, you can say he will produce the same results, same low results as he was doing it before, because looking to the back. So same if the company last 10 years they are in losses. So what you will do, which it will come in profit. There is a trend that we need to look at. And once we know the past trend, so last time we discussed zero-based budgeting and a traditional-based budgeting. Traditional says that look at your past and based on plus minus adjustments, you can make your budget. But the other one is what? Other one is zero based. We say there's no past and everything is based on a justification. So whatever is your assumption and method, accordingly sale forecast will change. So he says that one of the most effective way to do this is to plot sale on a graph and use regression analysis. Now regression analysis is y is equal to a plus bx, means that you put them into relation. So y is a dependent variable, x is an independent variable, and a stands for constant and b stands for variable. So this is what he says, this is the information year 1, year 2, year 3, year 4, and year 5. So almost there is a bit of growing trend. Every year sale is growing. So if you put the Excel, if you take Excel, you put the table and choose a graph. So graph will come similar like that. So this is showing an upward trend, and we can see from this graph that sale is improving. So using this information, like we have now first 5 year information. So what is the 6th year information? What should be? So as I told, there are different methods. First can be an average. I can add all these 1, 2, 3, 4, 5 and divide with each other, and it will give me per year an average, right? Makes sense. This is average method, and but there are other method also. It's up to you which method you would like to. But in the book, we have regression analysis or sale per year, the average annual growth rate. So first, we have to use this method and see that how much sale is increasing every year. So ending value minus beginning value divided by beginning value. So you will add all them and divide it with number of periods. So this is what this is another method that you take. Say, for example, in this table, you take this figure, then minus this figure, right? And divided by the original one. So that's how you can keep continuing, like second, then minus third minus second, fourth minus third, fifth minus fourth, divided by it, and then you will get an average. So you get the growth, and then make an average. So what we did is we add them for making average, because they are one, two, three, four figures. We divided with four. So you can say that on average, every year, the sale is increasing by 9% through regression method. So that's a pretty simple method. If any question comes into, you can sort out, make a table, take the highest, lowest, go year wise, divided with that, and get an average in the last. So that will be your aggregate. So manager will also forecast sales many years in future. So depending on what is the nature of the business, some businesses we predict 5 years, some we predict 10 years, some we predict 20 years. That's the way it works. So we have year 6, year 7, 8, 9, 10, 11. So you can see that these figures has been given to us. So what we need to do is forecast the rate of increase in sale will decline from 8 due to the forecast such as increased competition and marketplace and low customer demand. So this is just a very basic hypothetical figures. But if you really want to do an analysis, then of course, if you see 2017, 18, 19, and 2020, you will see 19 and 20 will be totally disastrous for most of the industries because they were not operating. So COVID was one of the reason, and there was several other connected reasons with it. So that's how, I guess, in the real life we can see that external factor, economy, currency, business cycle. Are we expanding? We are in recession. We are in boom. These kind of things are very, very important. Then we have another method called percentage of sales method. So this is getting popular. For example, you say my sale is 10,000. So I will take a percentage, maybe 6%. So there is a way to do it. It says after sales are forecasted, future financial statement must be forecasted. Obviously, like a sales is for income statement. Income statement, once you have an income statement, you can make a balance sheet. And from balance sheet and in this income statement, you can make a cash flow. So here is the interesting thing. Suppose if I ask you what is your salary, you say my salary is say 100,000. So, but I will be a little confused. And okay, if your salary is 100,000, but what about your expenses? Maybe your expenses are 90,000. So actually you have 10,000 always in your hand. So but if you say my expenses are 40% of my salary, so I can easily understand that 60% is your saving. So that's why it's a growing trend that we always try to make the percentage. We want to see things in percentage. So how it works is, see, this is actual year 5. Here we took a base. We said 11% increase. See, 1.11 means 11% increase. So it was 100% was 4,000. So 111% is 4,440. 80% of the net sales, then 11% of the sales, same as last year. So there is no change. You can see here 200, 200. This is 100 and 100. So you can see that income has increased from last year. And he made analysis, sale and selling are expected to increase by 11%. Cost of goods sold is 80. So here we took the 80, here we took the sales, and other revenue and interest cost are remaining same. So what we learn out of this is very simple, that we will take the actual column and then we will see item by item. In accounting terminology, I can say that talking about a chart of account. I will take all the accounts, then I will see what was the last year figures. Then according to the management approvals, I will see 2%, 5%, 3%, this way